Hello, this is Pat O'Mara, and I'd like to thank all of you for joining us as we talk about the future of capital markets in a decentralized environment and what is that going to look like. We've got some really fantastic people with us today. Daniel Barron, who is our Chief Legal Officer at Invenium. We've got Rick, our CTO at Invenium. He's here with us all the time. Thank you, Rick, for being an anchor member to this podcast. And then we're excited to have two additional guests, and I'll start with the most exotic, Alice, calling in from Singapore, and Alice is with IX Swap and InvestX. Alice, will you introduce yourself really quickly?
Yeah, sure. So I'm Alice Chen. I'm the co-founder and general counsel for IXSwap and InvestX. So InvestX is a Singapore-based and licensed tokenization SaaS platform, and we focus on tokenizing real-world assets. We essentially offer basically the end-to-end solutions for any Web2 investment firm to become Web3 compatible by offering key infrastructure such as token issuance, custody, a licensed secondary trading venue. That's InvestX. But we've also launched the world's first automated market maker under a sister platform called IXSwap. Essentially a version of Uniswap, but built specifically for real world asset tokens or security tokens. And IXSwap is licensed in the Bahamas. And it was really built to solve a missing piece of the puzzle in the whole security token industry, which is lack of market makers and liquidity. I'm based in Singapore. I've been in Asia for about 15 years, and I'm calling in tonight from Singapore.
Fantastic. It's great to have you. And Bob, you are in a similar business, right, here in the United States. Bob, tell us a little bit about yourself and Oasis Pro.
Sure. So Bob Yospiel from Oasis Pro. I have a long background in traditional finance, having spent 20 years at Credit Suisse and then time at Bank of America and the Royal Bank of Canada before I crossed into the digital world about 3 years ago here at Oasis Pro. Oasis Pro is a global fintech infrastructure provider with an end-to-end digital asset solution. We have a primary issuance marketplace and a secondary trading platform for digital securities to be traded against digital cash. We have a tokenization platform, digital transfer agent, and an API management tool that allows us to connect into the legacy infrastructure of large financial institutions. We partnered with JP Morgan and Apollo last year on a project, Guardian, out in Singapore, that's run by the Monetary Authority of Singapore, where we tokenized an Apollo fund, pushed it through the JP Morgan Onyx blockchain out to Provenance and Avalanche using an XLR bridge, and then did some portfolio rebalancing after that. So we're also a full service regulated broker dealer here in the US with the unique licenses to trade digital security tokens against digital cash being stable coins, which allows for instantaneous settlement, which significantly reduces counterparty risk. And I think that's where the big institutions are focused. While they understand the potential cost savings of smart contract and blockchain technology, the risk management solution, I think, is particularly attractive to those large banks. So, nice to be here. Thanks for inviting me, Pat.
Yeah, absolutely. And it's great to have you. We are around the world. Bob, you're in Connecticut. Daniel, you're in New York. Rick, Philadelphia, right? And I'm in Abu Dhabi today. And so we're the conversation is spanning the globe, which is appropriate because really and truly this is a global business, that we have the largest financial players in the world leaning into this next generation of capital markets, right? And this next generation of capital markets, whether we're talking about tokenized stores of value in the form of a currency, right? A stable coin, that is dollar denominated, asset backed, crypto backed, treasury backed, or a tokenized real estate asset that is through an AMM able to be traded back and forth with on a secondary basis using an AMM on a decentralized basis, and InvestaX as a centralized exchange, right? And I think what I want to do is I want to throw this out, right? What, Rick, you've been in this market for a long time, right? You've been in the trading of public market assets and indices for 30 plus years, overseeing trading systems, creation of indices for all sorts of big and small entities. How is this blockchain, decentralized data, decentralized compute, decentralized ledgers, how's that going to impact the next generation of capital markets?
Next time, please ask a little bit broader, open-ended questions so I have an opportunity to expand on something.
Yeah.
So I think, why is blockchain important to this is the first question I'll think about answering. And it's because if you want to trade securities, there has to be a clearinghouse. There has to be a way to settle the trade. We're not meeting underneath the tree and handing certificates over in return for cash anymore. And the DTCCs of the world work inside the closed environment of publicly listed securities, right? So if we're buying and selling shares of Alphabet, it's easy because there's an infrastructure set up for that. But as we see the world want to move beyond trading just this limited universe of public securities, which have their own characteristics, typically lower yield, lower risk in many cases. But they're just a small part of the assets in the world, right? Real estate is a bigger asset class than all the stock markets in the world put together, all the public ones, and all the private companies, and all the private debt, and private credit. So if we want to securitize those things and trade them without going through the enormous expense of making them public, then there has to be a safe way to settle the trade. And that's what the blockchain makes possible. And so, go ahead.
And you use the word securitize, right? Which means to turn something into a tradable instrument, right? It is tradable. It becomes a security. And whether we're putting a bunch of commercial mortgages or residential mortgages or the equity
or the houses themselves or the shopping mall or one part of the capital stack of the shopping mall, right? Just the mezzanine debt or something. Those things can all be turned into tradable securities. And yet you can't get the New York Stock Exchange to list the mezzanine debt of the King of Prussia Mall. But there could be 1,000 people who want to buy part of that debt. The holders of that debt might want to lay some of it off and diversify. So the opportunity to tokenize it, to securitize it, right, which Daniel would have to get involved in, right, and then tokenize that security and make it possible for people around the world to buy and sell it is very exciting. And then once that's done, with that in place, all sorts of financial engineering that's available to the holders of these public securities becomes possible. I can buy options, I can sell options, I can do futures, I can do swaps to swap some of my King of Prussia mezzanine debt return for S&P 500 return. I can, as you've pointed out, Pat, build an index of shopping malls around the country and go long shopping malls in Texas and short shopping malls in Connecticut or something. I mean, I'm making up examples, but the benefits of these derivatives markets to the commodities producers, to farmers, to people who do extraction industries are enormous. They just change their businesses for the better in such dramatic ways. And so the idea that we could bring those benefits to people who own commercial real estate or private credit is very exciting.
And what you're able to do is really isolate the risk and transfer the risk to others, to those things that you're competent to manage, right? So farmers can sell their next 2 and 3 years production, and they are managing and mitigating production risk only, which for a farmer, that's what they want. They don't want price risk. Does that make sense? And then meanwhile, you've got those who want to buy that production over the long period of time, and they want to turn that production of whether it's an orange or wheat into something that they're going to sell into the market, and they want to own that long dated contract. And what this does is it opens up the movement so that there can be liquidity moving around. And part of the issue is how these things are going to trade, right? And Alice, this is what you guys have been doing, right? Talking about centralized exchanges, decentralized exchanges, where people can trade back and forth their value in a thing. Because when you store value, you want to be able to not only buy it, but you also want to eventually sell it, right? And how do you maintain that? And maybe talk to us a little bit about once you've created an instrument that can be traded. I think how you trade it and where you trade it matters, right? I mean, you're in 2 different geographies, Singapore and Bahamas. One is a centralized exchange, one's a decentralized exchange. Why do these different types of venues exist, and why do you have them in these different locations?
Yeah, I mean, I was just going to add on to what Rick mentioned in terms of we've been digitizing, public markets for a long time. The whole growth of the public capital markets can be some development of new technology or new process flow, introduction of, even the DTCC itself, which is lacking in the private markets, is an area which Oasis Pro and ourselves and many others in this space are focusing on, tokenizing these types of assets that never had the infrastructure. So in a way, I think the biggest opportunity for tokenization, in our opinion, exists in the private market because there is no legacy infrastructure, right? So we have this whole possibility, and it's where we borrow concepts like AMM from the Web3 world and try to bridge that and connect to traditional financial systems. And so I'm sure many of you have heard, and actually I think Bob, you mentioned you were involved in Project Guardian. Project Guardian had 4 pillars. One of them was AMM, permission DeFi. And what is permission DeFi? It's basically having a trusted front-end interface. And that's what we equate IXSwap as, a regulated interface where users can access DeFi applications in the back end. And so kind of bringing those concepts together so you do have recourse and protections as a user, but at the same time enjoy the benefits of having a decentralized, automated system. So that is why we created IXSwap. InvestaX is a centralized system, and of course it has its own value, where you have certain types of assets only available for institutional and accredited investors, whereas IXSwap is available to all retail investors who pass KYC and AML.
And you mentioned this automated system, right? And I'm going to throw it to you, Bob, and then I'll come back to you, Daniel. This automated system, part of the issue is creating the token does not create the liquidity, right? There's so much more, right? And when you say we're automating, and this gets to what are we automating, right? Because there's so many different functions that have to be automated. And Bob, at the beginning in your introduction, you said we're an end-to-end system. Yep. What does that mean? And what are the functions that are being automated that are going to yield the ability to create liquidity in secondary markets where people can go in and out of these private market assets? What is the thing being automated?
Yeah, so I think it's really it's access to alternative investments that's being automated, right? I think in those alternative investments are hard to access. Not all Main Street investors have an opportunity to invest, let's say, in a private equity fund or KKR fund, for example. In a tokenized world where we would use our tokenization platform to create a smart contract, then issue it on our primary marketplace. People could purchase the entire token. Let's say it's a $250,000 minimum ask, or a fraction. Let's say 5 or 10%, which is much more accessible to Main Street investors. They can then put it on or move it over to the secondary trading platform to buy and sell into these products as they wish. There's also the ability to post that token as a collateral item. So if you own a private equity fund and you're happy with it, and then you need to write a tuition check to the University of Wisconsin at Madison for $75,000, you can post that token as collateral and borrow against it. And then we have a digital transfer agent that manages the cap table for these securities as well. The public markets, especially for equities, I think are generally pretty efficient. Where blockchain and smart contract technology really has an impact is in the private markets, particularly a yield-bearing product, a yield-bearing instrument. For example, a mortgage-backed security, the efficiencies that it gains is you can eliminate the need for a third-party asset servicer that does the principal and interest calculations and payments. And then as that token moves through the various pipes, there's less people on the buy side that need to touch it, and the asset management function, less compliance people, less product control, less operations, because everything is happening via the smart contract. So
yeah, and Alice made the comment that we've been digitizing the public markets for years. Right. And one of the things that you really do is Bob, you talked about administering these assets. Right. And it used to be, let's use Refinitiv as an example. Right. London Stock Exchange at this point. But when, it used to be that in New York, that at 4:30 they would send over the positions to the Netherlands. And then in the morning, they would go, hand quantify the value of those portfolios, particularly around options, send it back so it would be back in New York by 8 a.m. You know what I mean? And they would do that manual function using time zone arbitrage, get it back, and then it would be the portfolio would be revalued by the open of the market, right? Especially when there's complex derivatives in there. And literally this move back and forth. And then they began to automate more and more and more. And the data sets that were there around the public market assets, even when you were dealing with a derivative, the inputs were there so they could automate more and more. But when you have private market assets, the administration of the asset, the administration of the instrument, right, has all been done manually. There's 120-day, 150, 180-day lag on the mark on that asset. And what you're doing is, with data, becoming more and more ubiquitous, you're automating the access to the alternatives. But for us to understand the automating of the access, you have to administer this, right? And you talked about this. And Daniel, that gets very much into how we're administering and maintaining the underlying asset data so that we can understand its value, and then the value that run the waterfall and the carry calculation, and value the capital stack and value the portfolio so we can trade it. But what is the administration and support of these assets in private markets mean, and how big of a deal is automation of that? How big of a deal is that for the industry?
That question to me.
Yes, sir. Daniel.
Yeah, it is the biggest deal in the world. And there's a tremendous irony in how the DeFi markets have developed, or I wish I could call it developed, have not developed at full speed in the United States. And that is concerns about transparency and mystery and hidden identities and not knowing what you're investing in. And the tremendous irony is that blockchain is exactly the opposite. It is the ultimate tool for transparency, for including a data layer that has all the information that you need about an asset. And if you have the right tools to layer in, an audit trail that can explain every single number. You don't have to rely only on a third party's assessment. Every investment is a story. Every security is a story. What does the company do? How does it make its money? Where do I sit in the capital stack? And sometimes, especially if you're sitting in the seat of the lawyer, you've got to connect a lot of dots and put together pieces of a puzzle in order to figure out what's going on. And that's, how a lot of us make a living. But imagine if it was all in one place, and if the piece of paper or the book entry of a stock certificate could speak to you and say, I am a subordinated, interest in this debt instrument. I am a senior preferred stock. This is the preferred return that you will get, and you can click on the instrument itself and get what the terms are, and also know what you own and see the evidence of your ownership. You can see what the business is doing. You can check performance statistics. You can understand that there's some, substance, and you could see what the assets and the liabilities are. It's quite an incredible and revolutionary thing. And when you layer in AI tools and administrative tools, you can do things that we could only dream about just a few years ago. So it makes all the difference.
Yeah, and when you think about this capital markets, right? How capital is allocated around the world, and how deals are structured in such a way that people can come in with a pref or a participation or a carry or whatever it might be that you use to incent the various people to contribute their land, right? Or in order to build a development on it or whatever it might be. And what you're doing is you're incenting people all along the way. And then you have this capital stack that is very complex. And most of the time, the construction of the asset, what it took to construct the asset, is not the way the asset capital is going to be traded in an optimized fashion in the future. You know what I mean? You had a developer who had to assemble the land, and then he had to go bring all the capital together, et cetera. And then as it's repackaged down the line and it becomes investor ready, literally it changes. But the problem is, in the private markets, it's so decentralized and so diffuse that what happens is everything is so unique and ad hoc and one-off. The ability for institutional investors to invest is very difficult, right? And it's only when big markets form, right? And I love using this example, right? 8 years ago, late 2016, 2017, we were meeting with the London Stock Exchange, and we were talking about tokenization. And they said, hey, we've been dematerializing assets for 400 years, right? You're not doing anything new with tokenization. And they would tell all the stories. The number one driver of how ships were built was so that their holds could be divided in twelfths, so people could trade their holds. You know what I mean? Not so it was the best from a maritime, efficiency. And that's the wrong word. Please excuse me. But you guys know what I'm talking about. And what we're doing is, so it's not hydrodynamic, but literally so that they could trade it, because enough capital had gotten together that it could move the market. What we're doing is creating mechanisms where we're breaking all the elements of AML, KYC, valuation, structuring, administration, the pricing, the servicing, the master servicing account. All of these pieces are being broken down. And Rick, when we think about how assets are going to be put together, right? You were in the very earliest of days of creating spiders and indices, right? And literally that market has transformed and been rebuilt and rebuilt and rebuilt and rebuilt. Mm-hmm. From the very first index that was ever created to how ETFs are trading today. I mean, it's gone through many life cycles. Talk to us about the life cycles as you see private markets, these assets being put together, and their ability to see around the world and see where is capital and then drawing it to them real time. How is this going to change? How is these tools, how are they going to change that ability to draw capital and entice it?
Well, so to start with what you mentioned, you talked about structuring the securities, and that's very important. But even before that can be done, you need to have comprehensive information about the underlying asset. So again, I live outside Philly. I'll talk about the King of Prussia Mall. It's a big shopping mall here, right? First thing you need to do is describe that mall and all the leases that the various tenants of that mall have and their revenue sharing agreements, and understand the finances and all of that. Then you have to understand the capital stack, right? Let's say we're going to isolate the equity piece, and you have to understand the partnership agreement. It's probably a limited partnership, and the roles and responsibilities and cash distribution and cash capital calls rules in there, and what the general partner gets and what fees are taken out, all that sort of stuff, right? And then you have to understand what the other things are on top of it. Is there mezz debt? Is there a mortgage? Is there, what other kind of operating expenses or debts or things reduce the amount of value that comes just to the equity? And then you can create a security which represents the equity part of that stack. And
as you perfect the information on the legal structure, and as you perfect the information on the asset, how does that impact the ability for you to buy and sell that?
Well, it makes it possible at all, because without that, who's going to buy it or sell it? You don't know what in the world you're being asked to buy or sell. It's a pig in a poke, right? And that's the benefit that the public markets have over private markets, is that all of that stuff is made very clear and explicit, right? If you want to list on NASDAQ has all sorts of rules about what documentation you have to put together. And by the way, the Securities and Exchange Commission has a whole bunch of rules about what you have to report and what's material and what has to be made public. And then there are these public databases which make it all available and clear. So you can very easily make a very informed decision. Price discovery is pretty darn good. Maybe not minute to minute, but week to week. And if now I want you to buy part of the equity piece of the capital stack for the King of Prussia Mall, you don't know anything about it. You can drive past it and look at it, but that doesn't tell you what mortgages are on it, what mechanics liens are on it. So you have to make this all clear so that it becomes an investable asset. And by doing so, you open up doors to capital that are pools of capital that are enormous, that are looking for yield like these assets can bring to bear, but which couldn't practically invest in them because there was no data. So now let's talk about some private credit stuff, right? The private credit market's exploding right now. And yet the people who issue it hold it on their books. Well, that's okay, but if they could sell some of that off to high yield funds, huge pools of capital, always searching for yield, that would love to invest in this stuff, but it has to be clearly documented. It has to be valued at an arm's length process that's transparent and recognized. You need to get a credit rating on it. Well, how are you going to get a credit rating if you can't even describe it? So it just makes the things much more palatable to investors around the world. And these investors have a lot of money and would love the kind of returns that are possible.
If they have good data and they can trade
if only there's good data.
Right? Bob, let's talk about that, right? When you think about your customers and what they're trying to do, right? They want to access a broader pool of investors. Mm-hmm. They're willing to tell everything that they need to tell about it, right? Mm-hmm. But what they want to do is get that data into a fashion, in a format that it can be automated, that there can be automated surveillance, informing that instrument so that you can list it and trade it. Is that right?
That's absolutely right. And if you think of large private equity funds who are raising new funds, it's difficult. They go back to the same well over and over again. But in this democratized world of smart contract technology that people can access, as I said earlier, on a fractionalized basis, it democratizes the access to Main Street investors. And it allows investor protection because there is data available. The ownership is validated based on what's on the blockchain. So, in a complicated, let's say, King of Prussia Mall securitized bond, that the person that you're purchasing it from actually owns that bond. There is an immutable record that determines that. The data around, cash flows is available. The data around the capital stack is available. So I think, having, perfect information in a real-time basis is something that is another real benefit of what the digital asset world is accomplishing.
Go ahead,
I
Alice.
was just going to also just add from a technical standpoint, right? I think a lot of large financial institutions are concerned about data privacy and full transparency. But from a technical standpoint, you do have the ability to use the public infrastructure that are what are called permission public blockchains, right? And so you can actually customize what types of data are available to what types of users. And so these are ways that, the industry have come up with to kind of alleviate those concerns.
And Alice, there's a whole series of ways using zero knowledge proofs when the data, the blockchain is not a great store of data, but for certain pieces of information, right, where you want to you have a data feed for a daily price, et cetera, that's there. But when we think about, Bob, what you were talking about with these investors who want to access broader distribution channels because they keep going back to the same pools. Well, those big pools have gotten smart and they beat the heck out of them on fees, right? And so these fund managers, alternative fund managers, they know they can get full boat 2 and 20 from when they go through the UBS channel and the Morgan Stanley channel or directly through your platforms. But when they go to CalPERS, they're getting 35 basis points, right? And I use an example of Cliffwater, right? TA Associates bought it, the majority control of it, threw a bunch of money at it, and they went from, once every 7 years liquidity to, an interval fund where you had monthly liquidity, and they were basically throwing bodies at the back and middle office in order to price that portfolio to get an interval fund. And they went from a $6 billion portfolio where they were earning on average 35 basis points to an $18 billion portfolio in 1 year. And 12 billion of that was paying the full boat 2 and 20. That changed completely the nature of who that manager was. You know what I mean? 96% of their revenue or their profit came from the interval stuff, but the only way they could do it because they were throwing bodies and they had a big giant checkbook behind them. But this is what the automation of the middle and back office can do in order to get this broader audience who's willing to pay 2 and 20 because they don't get any access to this stuff. You know what I mean? Right. And Alice, as we see this automation being delivered at scale, and people are saying I can have full fees and not beat to death by the same investors, but I can have a full set of fees in order to execute my strategy. How does your platforms and the ability for you to price something and getting AMM going, how does that change people's willingness to get in on a trade? Does that make sense? How fundamental is that to opening the door for retail getting involved?
So basically, are you asking with more assets going on chain and better transparency? Obviously, I think you get better price discovery and more accurate kind of valuation of these assets. I think one of the biggest problems we've seen in private markets has been the opaqueness, and which leads to, of course, we all know how you're able to get a heavy discount to the NAV in a traditional secondary sale due to that illiquidity discount. And it's one of the things that putting assets on chain, tokenizing assets, is one of the ways that you can actually allow more price discovery. So yeah, it definitely, in terms of all of our assets, when we talk about automation, all of the assets are transacted through smart contracts. You have price discovery on chain, and everything is executed on our AgSwaps platform through automated smart contracts. Essentially, there's no chance of manipulating a price, or it's basically market demands. Whatever the market's willing to pay for it is what you're getting in on our markets. So I think one of the things I've always talked about, I teach a course at SMU in terms of why we see private markets as being the biggest opportunity. Why? Because they are private by its nature. You have lack of transparency, lack of data points, and it's something I think you guys at Invinium are trying to solve with your services and functionalities.
Yeah, and Daniel, I'm going to go to you because you've been a director at private funds. You've been a general counsel for private funds in Europe and in the UK, etc. And just the marking of these assets and getting the third parties to set the marks, man, it is a pain in the neck. And what does the automated processing do and the pricing of it? Opening the door for what Alice is talking about, which is AMM, and the ability to conduct an orderly market in order to aggregate order flow so that you can match buyers and sellers in a manner that you don't have a single buy or sell moving the market. You know what I mean? How are these new technologies going to transform what are traditionally very manual things that have slowed the market?
It's nothing less than a revolution, and I don't use that word lightly. You would be shocked at how inefficient the process remains. In a typical regulated fund in Luxembourg, you have basically numerous providers that need to access the same set of information. You have a custodian, you have an administrator, the depository, a management company, an appraiser. Each one of them sort of has to reinvent the wheel, access the info its own way, replicate results, share it in accordance with its own compliance procedures without any system. And then eventually you get an NAV. It costs a lot of money. It takes a lot of time. And there's a lot of blood, sweat, and tears because all these people are asking the same questions since the data doesn't speak for itself. You could basically upgrade all of these private market assets in a way that makes them more cost-effective and accurate to administrate. And then once that NAV is produced, you could use the tools of automation in the capital markets globally to market minority interests in these funds in a regulated way that was just simply not possible beforehand. It is shocking how much is still done, to the point that sometimes the providers do diligence on each other, and I'll bring you an extreme but real example. And each one has a right to audit the other's documents. And I've actually seen several cases where provider A says to B, I want to see your documents. And provider B says, yes, you must come to our Luxembourg office and sit there and review the paper copy. And that's just silly. It doesn't make sense. And there's a better way to do it. And we are going to change all that, because once somebody adopts these new solutions at full scale, everybody is going to have to follow suit.
And this automation is not one thing. It is not just smart contracts. It is not just AI. It is not just robotic process automation. It is not just ML. It is not just AMM, which is a function of 2 or 3 of these things coming together. It's all of these technologies and the broadband capability, the data sharing, the data science. It is the compute on demand. It is the decentralized data. It is a decentralized ledger where you can do this. And as we begin to put all of these things together, that's where there's going to be a revolution, because we're automating how data is shared, how we trust the data, what is the context for it, what is the attribution to service it, so we can understand the asset, so we can trade it, so we can finance it, so we can build it. And that's when Bob Oasis Pro becomes transformational as a mechanism of finance for individual assets and funds, right? And who are the people right now who are leaning into you, who are saying we need this automation, we want this automation, and what is the value proposition they're coming to you to achieve?
Is that directed towards me, Pat?
Bob, yeah, what is the value
Well, I
proposition?
think I think where people, where there is demand for this, and there's real demand and it's active today, is in the repo market, where banks are constantly trading amongst themselves to fund their cash needs, whether it's putting up treasuries for collateral and getting a cash from a different bank. There's a real need for that. In 2008, the financial crisis, people didn't realize, or the banks didn't realize, how much counterparty risk they had and how much exposure they had within the banking system. And there were literally people pulling repo agreements out of filing cabinets that had been there since 1994.
There's a famous case. What was the big bank in Chicago that got upside down in the repo stuff in 2008?
First National. It was a First National.
I think that's right. Yeah.
Yeah. And other downstream impacts was people didn't realize that AIG had guaranteed the Lehman Brothers lease in Canary Wharf in London until 3 weeks into the crisis. So there wasn't perfect information. There wasn't real-time information available for these institutions to understand where their counterparty risk lied. So I know JP Morgan and Deutsche Bank right now are doing repo trades through the Onyx blockchain. I think this will become the norm and the standard.
And go ahead,
I was
Alex.
just also going to add, you coming back to this automation, I think it's important to highlight that, all of the rails need to be on chain. So not just the assets, but also the investment funds, whether that's in the form of, a stable coin or a CBDC. But in order for that to truly realize the full potential of having assets on chain, the other side, which is the payment rail, needs to be on chain. So on IceSwap, we effectively facilitate the trading and swaps of any approved, let's say, fund units, where both the investment funds and the fund units have to be represented on chain. We do not deal with fiat at all. So issuers of such fund units, once they pass KYC, AML, and the due diligence screening, then they can set up their own liquidity pools with those fund units, the tokenized fund units, and start trading. So in a liquidity pool on IceSwap, users can deposit these funding units into a smart contract and forming a pool of funds. And these funds are used to provide liquidity for specific trading pairs. It can be paired with any form of cryptocurrency or a stable coin. And when a user wants to make a trade, the smart contract uses the funds from the liquidity pool to execute the transaction. So in this way, traders do not require another trader to be present on the other side of the trade, but they interact directly with the liquidity pool. So basically, it's a crowdsourced kind of market maker solution.
when you just made an announcement, you had a group and make a meaningful investment in you and a partnership, right? And they are all over the world, and they are money. They move money, they transmit money, etc. They're getting into Web3 for precisely this reason that Alice talked about, right? The future of how we move and store money is going to be on these types of solutions. Talk about that partnership. Why did they want to partner with you?
Well, I think they're a big payment firm, but they recognize how our technology, the issuance platform, the secondary trading platform, could help not only in the payment space, but move assets between portfolio managers, asset managers, banks, et cetera.
Yeah, and it's gonna be transformational. And as you have an AMM, where you have a tokenized fund interest, and then you have a stable coin on the other side, and the ability to go back and forth, and you have that pairing. Then you have another pairing where you have a stable coin versus a third one, and as long as there's commonality, all of a sudden these pairings in connection to one another are going to create the aggregate liquidity to trade a ton of things back and forth, right? And Uniswap and SushiSwap, one of the functions that they have is they use this thing called constraint-based programming, where they try and maximize the number of pairing trades per transfer, so that if they could get 10 trades done, at the best price, but they can get 40 trades done on an aggregate better price to bring liquidity across, they maximize the number of pairings to get back and forth. And what that does is it creates liquidity, it creates flow, and it allows liquidity to be in here. And Rick, again, I want to go back to what you did at the beginning of ETFs and the beginning of these indices, right? And just talking about spiders. Creating the indices itself was hard. Number one was hard, and then number two, and then three. And talk about the iterations that have brought more and more liquidity into it.
Well, so Standard & Poor's created the index that's underneath spiders, right? It's the S&P 500, and it's probably the most famous of the modern good indices, in that it's market cap weighted, less per chain. So you say, I've got a basket of 500 stocks, and then you sort of pretend you own all of those, all of the stock of all 500 of those companies. So the bigger ones with the larger market cap carry more weight than the smaller ones. And you add all that up, and on the first day you say that's 1 or 100. I think they started with 100, right? And then the next day you price that same basket of stocks, and it's gone up 3%. And so you multiply that, and now the index is 103. Now it gets complicated because there are all sorts of things that happen. If you go globally, there are rights offerings, there are splits, there are mergers, there are delistings where they move one company out and another company in. So there are all kinds of corporate actions that affect the capitalization, and you can't just use today's price versus today's number of shares, or yesterday the shares. Anyhow, so you have to take into account all of those things as you're calculating the index every day. But it's possible to do, and Standard & Poor's did it carefully and was doing it on a daily basis. They now do it much more frequently than that even. So if you then want to assemble a fund that maps and matches the performance of the S&P 500, you have to do that same construction and say, okay, here's what the index is today. Here are the relative weights of all the different components of that. Then I can't afford to buy the entire S&P 500, all those companies, but I've got $1 billion in this portfolio. And so allocate that $1 billion proportionally across those stocks. And then you come up with your ideal portfolio for the day. You compare that to what your actual holdings are. You apply cash flows in and cash flows out because that affects it all. And you come up with a trading program for the day for the fund. So having done that, you end up with a fund that pretty closely is going to match the performance of the S&P 500. And then you can unitize that fund and sell those off, and those are the spiders, right? And you have to get paid for that. So what they do is they keep some of the dividend yield, right? So which works better for certain indices than for others, right? NASDAQ stocks, like a NASDAQ tech index, that might not pay enough because there aren't a lot of dividends by those companies. But there has to be some way to pay the people who run the fund.
And it used to be that you could actually turn in stocks and get.
To my knowledge, you still can, and that's part of what we built. We figured out that at the time, a creation unit, it took about $2 million. And if you had $2 million worth of spiders, $2 million, so there was enough resolution so we could turn it into shares to match that proportional distribution of the market capitalizations of the 500 stocks. If you turned in $2 million worth of spiders, we'd give you back a basket of $2 million worth of the underlying stocks that were proportionally like the S&P 500. And this was a way to keep the price accurate, to arbitrage the price of the spider back to the actual underlying stock.
And the thing that I want to say is that Alice is building the building blocks one asset at a time or one fund at a time. But what we're going to do is once there's enough of those things trading on AMM, we're going to create indices, right? And people are going to be able to contribute their real estate asset that in a trusted valuation manner, and they're going to be able to get those creation units. You know what I mean? Where they resolve that into a basket of underlying assets. So if I own a piece of a portfolio of multifamily housing, and that multifamily housing portfolio or asset is in an index, I'm going to be able to trade that in and out. And what this does is it's going to transform how assets are financed on the individual basis, because people are going to have marks, they're going to have trading on it, etc. Rick, I'm sorry, I wanted to just kind of speed that up.
That was right. I just want to say one other thing is once an index has credibility in the world, right, trading can just be done against its published number. So you could go to Chicago and you can trade S&P 500 futures without anybody owning the underlying S&P stuff, right? You put T-bills in as collateral for your margin account, and then you can buy or sell S&P futures, which are going to have cash settlement just against what the published S&P 500 value is. And it has to be a credible index before people are going to do that, right? Before they're not going to believe they can get gamed with the cash settlement. But I think that more than, real estate doesn't move around that fast. Right now, when we get through the hurdles of securitizing it and fractionalizing it, but fractionalized debt is much more difficult to make it legal to trade. Daniel can tell us about that than whole debt. Right, whole debt you can move around. As soon as you fractionalize it, it's a whole different regulatory nightmare. I'm not sure how that's going to affect some of our other asset classes, but there are still opportunities for us to create an index if we get enough commercial real estate so that we can start publishing a France index and a Paris index and a New York index and a Germany index, and figure out the problems of how to weight those things appropriately, et cetera, et cetera. I think there are a lot of people who could use hedging, who could make not just speculative. The speculators provide liquidity, so they've got a role, but I think there are real substantive potential uses for indices like these against the kind of asset classes that we're talking about once we get them documented so the index is credible.
Right, and that cash for difference settlement versus resolving to the underlying is incredibly important when you have illiquid underlying assets that you don't want to trade title to. You don't want to be moving the title for an office building back and forth. You
Right.
want to be able to be doing this derivative function
Right.
trade. We have about 5
And
minutes.
accelerating against real estate. You know, if you're doing swaps, for example, and you go the wrong way and you need to collect the collateral, doing that against real estate is incredibly awful. But doing that against units in a limited partnership that owns the real estate can be pretty straightforward. So
it could be done in T+3.
Yeah.
Exactly, right? You can accelerate against a margin loan, against an interest in a fund versus accelerating against the underlying asset. So much easier, right? So the ability to, if you have a tokenized security in a fund that the valuation is trusted, the ability to borrow off it just goes through the roof, right? And it couldn't agree more. Let's go. We've got 5 minutes left. Daniel, I want to give it to you first. Give us 2 minutes. Talk to us about the future of capital markets. What is it going to look like in the future? We're looking for a prophetic statement. Where are we going to be, and what is decentralization going to bring about for these decentralized capital markets for private market assets?
Decentralization, I think, will open new access to capital to people who couldn't, previously get to it because they couldn't tell their story. They couldn't get their asset in front of investors and give them the comfort that the investor understands what it is and what they're getting, and B, ease of execution. The private asset transfer process can be a nightmare, especially in Europe, but by using decentralized DeFi protocols, but having standard procedures that we can identify investors and get asset classes in front of them, we can enable more people to invest in a wider range of assets and basically create new sources of capital for these private market assets. And that will change absolutely everything. The price discovery will drive it. The ease of execution once everything is on chain, as Al said, and the payment rails will make it possible. And it'll enable people to have exposure to asset classes they never could even dream of.
Bob, final words.
Final word, I think the regulatory agencies around the world need to get comfortable with this. I think one of the concerns is around anonymity, which is, a little ironic given the fact that there are a number of jurisdictions around the world where private bank customers are protected by law and are anonymous. It happens in Switzerland. If you disclose the name of a private banking customer, you will go to jail. I'm not suggesting that anonymity is a good thing in a decentralized place, but I think the regulators need to take a good look at what's happening in traditional markets before they can opine on what's happening in the DeFi markets.
The Bank Secrecy Act of 1973, there was litigation against it, and it went to the Supreme Court in 1974, and the Supreme Court ruled that $10,000 per limit, the only reason is because it's such a large sum. And in their actual verdict, they said, as an example, you can buy 2 Corvettes for $10,000, right? That is such a large sum. Nobody would spend $10,000 without it being an institution. So this in no way surveils the individual and their rights. It's amazing what inflation has done to that kind of logic of the Supreme Court, right? Because the Supreme Court was saying the government has no right to surveil an individual for anything that is an ordinary transaction, commercial transaction. Alice, I want to give it to you. You have the final words on how these centralized capital markets will transform the world.
Well, I think we started out as a crowdfunding platform in Singapore, and our ethos has always been around supporting projects. The ethos that is pretty aligned with the whole DeFi and Web3 concepts, building communities, accessibility, transparency. So we look at tokenization, DeFi, as next generation crowdfunding. That's as it relates to our own businesses. And what we are trying to do is really bridge those concepts. I keep on going to that, bridge the DeFi world with the traditional finance world. And one of the things that we're really excited about with IkeSwap, and I think we just announced this a couple days ago, it's never been done before, a staking program where you are now going to get airdropped RWA tokens, right? So, I think the potential of all of the innovations that are coming out of Web3 is enormous. And we really need to just pay attention to that space and adopt those that really work into traditional financial systems. It'll improve access, as Daniel mentioned, and it's not just access for issuers to an alternative fundraising source, but access for the investors as well to invest in assets they've never been able to participate in. So that's kind of how we look at tokenization and Web3 and this whole DeFi concept.
The automation is going to transform price discovery, administration, servicing, all the price discovery, all of the trading, all of the listing, who the markets are. And it really is, we're going to see a transformation, we believe, as this tokenization functionality brought by people, Alice, like you and Bob, are going to change who has access to private market assets and how people save. I want to thank everybody for being here. It's been great to be with you guys. God bless you. And thanks everybody for watching this and being a part of this podcast. God bless you guys.
Thank you.
Thank you.